Hello traders, how are you? Vladimir here from Traders Academy Club. In this video, I would like to present you how you can make money trading indices with CFD, contract for difference only. You don't need any other instruments, only indices. I will be presenting the S&P 500, for example. However, I would like to mention that this strategy could be implemented on any instrument of your choice. Okay, if you prefer to work with the S&P, welcome. NASDAQ, DAX, FTSE, you name it, you have it. They all will work and respond beautifully to this strategy. This strategy has several very easy to follow rules. But before I go and explain these rules, I would like to ask your help and your support. If you appreciate this video and the work we do for you in this channel, please hit the like button, subscribe to the channel, and remember to enable notifications. And thank you very much in advance for your help. So let's take a look on the S&P 500, and once again, you can use any of your preferred indices. I'm using the S&P 500 for this example. It's one of my favorite, this and NASDAQ for the US session trading. This is my time zone, but this is where the time zone I'm based, and that's why I prefer these indices. Again, you can use any of yours. So the very first rule which I would like to explain is define key trading levels. Okay, that could be supply and demand. Let me just mark the chart. That could be supply and demand. That could be a key rejection area, falling resistance or rising support lines, like trend lines, and a classical volume-based level, which I will explain in a minute. Okay, but before I go and start showing you all the things, I would like to take the moment and to thank ActivTrades broker for making this video possible for us. So the first thing is to define the key levels. Okay, as you can see in this example, I see here a beautiful support that once it was broken down and retested, it becomes a resistance. With this high being created, it becomes a supply area of interest where the sellers took control. Okay, the next important thing which I want to check is here. Look at this amazing volume profile based indicator of mine, the key trading levels indicator. As you can see, a massive, beautiful cloud here, creating a strong rejection area, a zone of balance, an area where there was a lot of transactions going between the buyers and sellers. Area of interest. Okay? My assumption is if that price comes back to this area, there would be an interest between the buyers and sellers, and the price could react. Boom. First of all, why do I want that? Because I want to trade from levels where there is a higher probability for price reaction. As a trader, I cannot make money if the market does not move. The only way as a trader you can make money if the price moves since the moment you buy or sell. Okay. By the way, one of the reasons I love to implement this strategy in a CFD contract, in a contract of difference, is because I can easily buy and sell any asset without owning nothing. This is a huge important advantage of the CFD and the reason why I use this strategy only this way. So I define the key level, then I want to go to rule number 2, and rule number 2 for me is going and checking that the session, at least one session, ideally two, before the session I trade, there was a clear trending structure. In simple words, if I am looking to implement my trading at the beginning of the US session, because again, this is the relevant time zone for me, I would want to check the London session and ideally also the Asian session before, that there was a clear trending structure leading the price towards this zone. So if it's a zone of supply, I want to see a rally before. Okay, and the reason I do that is because the market, especially when it comes to indices, has a very beautiful sort of nature to react to the opposite direction in the following sessions. So when I have at least one session, ideally to synchronize to the same direction before the session I trade, and you can see here clear flow of higher highs, higher lows, which is a beautiful bullish control approaching towards the key level I just marked before, as you can see here. Okay, this is the zone. By the way, you remember the volume we saw there. Okay, let me just go for a second. You remember the volume area we saw here, okay, from the day and the weekly as well. So as we enter the zone, I want to make sure there was a trending structure in a session, ideally more than one, before the session I trade. Clear structure of higher highs, higher lows. And the final thing, I want the signs that the buyers are running out of steam. How do I do that? By checking for a bearish divergence. Bearish divergence is a condition when the chart still showing and creating the higher highs while the indicator shows lower highs. So if I check the price, I can clearly see higher highs here. And if I check the MACD indicator, I can clearly see lower highs. If you prefer the RSI, you can also see lower highs on the RSI. So this is a beautiful sign that the bearish divergence is developing on a key level at the end of the previous two sessions, leading the price towards the key zone. Great probability that the next session would be reacting to the downside. And this is exactly what I will be looking to trade. Okay, so there are several ways to attack in that case. You can go and attack the levels. This is aggressive trading. You can go and attack divergence once the divergence completes and the MACD ticks to the downside, or you can do what is one of my favorite style, wait for the price to switch. So from higher highs, higher lows, this is the first time when the price creates the lower lows and the indicator as well, creating the lower lows. And this is a sign for me that the trend possibly changed. So I would be looking to sell the pullback right now, heading towards the next key volume area I will be finding. That's it. These are all the steps how I implement these amazing strategies. So I showed you an example for a sell. Let's take a look at an example for a buy. For a buy, I'll be looking for demand level, key supportive area, rising supportive trend lines if there are any, and of course the volume area. So we can see this low and this low create the zone of demand. Then we have this volume zone and this swing high, which is a supportive area, and then we have this low and this low and this daily volume zone, which creates another zone of demand. Okay, that's it. This is the first sign definition. Then I'll be going to the lower time frame and I'll be making sure that the session before, at least one, had clear trending structure. So you can see the trending structure here. It's pretty clear. You can even see that it was more than one session, right? It's pretty much seriously ongoing for several sessions. So it stands for all the conditions I want. Now I'll be looking for a bullish divergence. So what I will want to see is the slowdown of the sellers, meaning I want the price to create lower lows. However, the indicator should create higher lows. For me, ideally, it's the moving average of the MACD. If you personally prefer the RSI, it could also work pretty well. The most important thing, the conditions I mentioned, don't skip them. Okay, don't try to bend and say, that's missing, that's fine, this is not there, it's fine. No, try to make sure you have all the conditions there, because it simply increases your probabilities, the odds of yours to be right. So if the market manages to create the lower lows on the chart versus higher lows on the indicator, it would give me an idea that a potential bullish setup will be following. So ideal scenario for me would be something like that, when the market would make the lower lows, the indicator will make the higher lows, and then I will want the flip. Okay, higher highs on the chart, and I'll be looking to buy the pullback. Okay, so that's how I implement my strategy. Once again, clear 3 rules. If you want to sell, first of all, find key supply levels, resistance levels, and volume profile based levels. If you want to buy, do the same with the demand zone, support zone, and the, of course, volume-based buy zones, okay? The zone of balances. And the next thing is you want at least one session before the session you trade to have clear trending structure leading towards your marked zone. You want this movement to end with a relevant divergence. If it was a rally, you want bearish divergence. If it was a drop down, you want a bullish divergence. And then you can go or aggressive and trade the level, the divergence, or be more conservative like myself in these cases and look for the price to flip. Okay, after a downtrend, you want to start to see higher highs, and then you can really look and buy the pullbacks. If it was after a rally, you want the lower lows, and then you can sell the rise. So that's pretty much it for this video. I hope you find this strategy useful and helpful. And I would like to take the opportunity and to invite you to join us in our trading family, Traders Academy Club, and enjoy the best of these things, as you can see on this very image we have to offer. And the last thing before I finish is pay attention to what index you are trading. If it's the S&P and the NASDAQ, you would want the most active hours, the most relevant, valid hours for your index. Okay, it's very, very, very important. If you want the Nikkei, make sure you trade in the Asian session. If you want the S&P and the NASDAQ, you would want to trade it in the US session. Why? That's the most, usually, of course, the most active hours and your chance to catch more relevant levels and more relevant movements. So that's it. Thank you very much for your time. I wish you and yours all the very best. Don't hesitate to ask me any questions if you have any in the comment section below this video. Feel free to share this video with anyone who you believe can benefit by watching that. Thanks again for your time. All the very best. I'll see you soon with more. Bye for now and good trading.